Hi, my dear friends. Punarvas Jayakumar here. So, guys, many of you have been asking me to do a quick analysis of the budget, though I have done a funny version or a punny version, so to speak. But then that is just for fun. But here's the real deal. Let's analyze the budget, and I'll be taking you through the amendments in the direct taxes portion, which is my subject, and let's see how things have panned out in the budget presented yesterday by Srimati Nirmala Sitharamanji. First of all, the biggest thing, talk of town, so to speak, is the amendments in capital gains. So basically, 2 clause 42A proposed to amend that for all the listed securities, etc., holding period, it will be 12 months, and for others, it will be 24 months. So as you know, my dear friends, earlier there used to be 3. So slab A, slab B, slab C. A was any security other than unit listed in a recognized stock exchange, units of Unit Trust of India, units of equity oriented mutual funds, ZCB and all that. Then immovable property, then shares of company other than that, that is unlisted shares. For unlisted shares, period of holding was 2 years. For immovable property, it was 2 years. For other securities and listed units, it was 1 year. And for other assets, anything other than that, was 3 years. So now what they have done is listed units of a business trust, they have brought it under the 12 months category, and the other areas, unlisted debentures, etc., that will still remain the same, but there have been quite a few changes. So ultimately, instead of 12 months, 24 months, 36 months, it is just 2 now, 12 and 24. So if you read the memorandum, that's what Nirmala Madam has told here, that units of listed business trusts will now be on par with listed equity shares at 12 months instead of earlier 36 months. And holding period for bonds, debentures, gold, etc., all this earlier used to be 36 months. Now that will reduce to 24 months. Apart from that, unlisted shares shall still remain in the 24-month category. There will be no change. Given that unlisted shares and immovable property, it shall remain at 24 months. So basically very simple, two things, 12 and 24. Apart from that, the rates also, she has definitely changed. There used to be multiple rates. For some, it used to be 20%, and then some used to be 10% without indexation, and then 20% with indexation. And the short-term capital gains also under 111A. There were varying rates. I mean, some were slab rates, but in 111A we had 15%, so to speak. Now anyway, to ensure uniformity and to rationalize everything, a huge change that has come would be this. You see, the rate for short-term capital gain, etc., earlier, as I told you, was the present rate of 15%, but now they are increasing it to 20%. This is for which STT has been paid, that is 111A, short-term gain, equity shares, units of equity-oriented mutual fund, and units of a business trust has been increased from 15% to 20%. And LTCG, as I told you earlier, there used to be 10% for listed equity shares and units of equity-oriented fund and business trust under 112A for long-term. So that was with indexation, etc. And now, very, very simple, guys. For that portion, it was covered under 112A. It was just 10%. And wherever you have to apply indexation, it was 20% with indexation. Right, under 112A, it was just directly 10%, and apart from 112A, other things, that is 112, so to speak, that was 20% with indexation. So now the concept of indexation itself is removed. It's like very easy now. Blanket rate, how much? 12.5% to everywhere without any indexation benefit. Right? So that is what it is. Wherever you are charging under slab rate, it will go to slab rate, no problem. Apart from that, wherever the short term was there under 111A, whatever was for 15%, it has been increased to 20%. Then long term capital gain, whether it is 112A or 112, they have removed the entire provision of 20% with indexation, 10% without indexation, and all those things, and directly they have made 12.5%. And under section 112A, there was since there is no indexation as such, there was an inherent benefit of 1 lakh rupees deduction. 1 lakh rupees, there was a exemption sort of a thing which was there. Now that has been increased to 1.25 lakh aggregate for the listed shares. One more interesting thing for unlisted debentures and unlisted bonds. Unlisted debentures and unlisted bonds, period of holding was 36 months, as I told you. Now that has been shifted to what? 24 months. And whether it will come under, definitely it's not an equity oriented fund or anything like that. So it's unlisted debentures and unlisted bonds. So what rate would you charge on this? So in the newly inserted section which was done last year, 50 AA, that was for market linked debentures. This also, unlisted debentures and unlisted bonds also have been clubbed in that particular thing of 50 AA. So hence it is deemed to be short term. Though it is short term or long term, I don't care anymore. It is deemed to be short term. Short term capital gain, it is at the applicable slab rate. So that period of holding for unlisted debentures, unlisted bonds really don't matter. Whether short term or long term, it will now be taxed under the normal slab rate, which was there for 50 AA. So 50 AA, if we have to speak about that, which was earlier, let me just come to that quickly. So in the Finance Act 23, equity funds, if you see more than 12 months LTCG 112A, 10% in excess of 1 lakh, that has become 1.25 now, right? And here less than 12 months STCG 111A, that is how much? 15%, that has become 20% now, right? So this 10% in excess of this 1 lakh has become 1.25 lakh. And this 10% now, it has become 12.5%. Less than 12 months, 111A, 15% has become 20%. As far as mutual fund is concerned, equity oriented mutual funds would come under the same category even now. Debt and hybrid mutual funds, this included something called as market linked debentures. Market linked debentures were in which the investment in equity would be less than or equal to 35%. That was called as market linked debenture. To that also there is an amendment with respect to the definition. So here it was 36 months and more than 36 months and all those things. Now that 36 months category only is removed. It is now 24 months. If it is less than 24 months, anyway it was a slab rate. Which is more than 24 months, it used to be that 112 proviso, 10% without indexation, 20% with indexation. Now in Finance Act 23 only they removed it. And they made everything will now be slab rates deemed to be STCG under 50 AA slab rates is what was there. Now to this list what is added? Unlisted debentures and unlisted bonds. Unlisted debentures and unlisted bonds are added to this particular list. Very, very simple. The indexation benefit is completely removed. For any long-term capital gains which is presently available for property, gold and other unlisted, there is no concept only of, what do you say, indexation. So if you see the gist of the story, listed equity shares, existing holding period 12 months, proposed also 12 months, no change. The existing LTCG rate 10% without indexation, proposed 12.5 without indexation. STCG for listed equity 15 has become 20 as discussed. Listed equity mutual funds with 65% or more equity contribution, 12 months, no change. 10% without indexation has become 12.5% without indexation, and 15% has increased to 20% for short term. Listed debt mutual funds up to 35% equity contribution or market linked debentures, this is under 50 AA. There is no holding period, not applicable only for that, as I told you. So it is taxable as STCG as per the applicable rates. No change here. Proposed LTCG, no change. Existing STCG, same. Slab rate, no change there. Then listed business trust, REIT, Real Estate Investment Trust, and InvIT, Investment Trust. If you see 36 months earlier, now deadly, it has been brought under the 12-month ambit. And 10% it used to be there, now it is 12.5%. And this 15% short term has become 20%. Unlisted equity shares, 24 months earlier, 24 months, 20% with indexation it used to be, now it is 12.5% without indexation. Slab rate for short term, no change. Unlisted bonds and debentures. Earlier also 24 months, now also, 24 months. 20% with indexation used to be there, now it is slab rate without indexation. This also, as per the memorandum, has been clubbed under. Unlisted debentures and unlisted bonds are proposed to be brought under the applicable, including them under the provisions of 50AA. So this also, my dear friends, will come under 50AA now. Whether short term or long term, everything is slab rate. Slab rate. Immovable property, yes, 24 months, 24 months, yes, 20% with indexation, now 12.5% without indexation. Now, I wanted to analyze the impact on the gold market. So I have collated the year and indexation of all these. This is what I was doing today, just to understand what it is, and I've taken the approximate rate of gold per 10 grams. This is the actual rate for the entire year, average rate for the entire year. I've taken it, after the statistical research. These are the actual figures. So per kg cost obviously will be this for 10 grams. This is how it's going to be. Anyway, now assume in 2024, let's say you bought, how to read this is very simple. In 2001, I had bought it for 4,30,000 rupees. If I am selling in 2024 for 75 lakh rupees, what would be the gain or loss? Because in 2024, if you see, it's almost around that rate only. Let's assume I am selling it for 75 lakhs, market rate I am selling. Approximately I am taking, just for ease of use. So now, for a 2021, if I had bought it in 2021, if I had bought the gold in 2021 and I'm selling it in 2024 for 75 lakh, pre-budget it would have been, I would have paid 3,98,427. Post-budget I am paying 3,36,260. Actually there is a gain. 2020, however, gold rates were slightly higher that time. So only there in that case, if I am selling that, I would be paying more post-budget, 20,000 rupees more. So wherever I have marked red, that is a loss after the budget. Wherever there is green, that is a benefit, which means the post-budget rates are only better. So as you can see, as per the statistical analysis that I have done, in 2020, whatever you have bought in 2020, if you sell today, you will be at a loss. Similarly, whatever you had bought in 2009, 10, 11, 12, 13 continuously, these 5 years, if you have bought the gold that time and if you plan to sell today, this will definitely be a loss. 20,000 loss, 1,70,000, 1,74,070. But barring that, in any other year if you have bought, guys, these are actual figures taken, what are the average rate of gold, etc. Based on that only, with the indexation I have taken. So with pre-budget you used to get indexation, now there is no indexation. So 2009, 10, 12, 11, 12, 13, if you have bought gold, if you sell today, gone. Anything else, no problem. In fact, in 2001, 25 years ago, 24 years ago, your parents had given some gold or kept gold for you. That if you are selling today, you will be saving a tax of 3 lakh rupees. Right? Yes. So there is definitely, as far as gold is concerned, barring these so many years, other things, there is a benefit. This is what the meaning of, if you see, the meaning of rationalization as per the memorandum. Rationalization as per the memorandum was this meaning only. Let me come to that. The rate of long-term capital gains, various sections, is proposed to be 12.5% in respect of all categories. In respect of all categories. Consequential alignments, they do all these things here, fine. That is what. The taxation is proposed to be rationalized and simplified. That's the meaning of what they're trying to tell. Now let us understand the property. With respect to the property now, I have taken, I'll just tell you what my assumptions were. Let's say if I bought a property in 2020 for 20 lakhs in 2001 in Bangalore, approximate appreciation of 10 to 15% on average is what I have taken. And especially during COVID, if you remember, there was, after COVID, there was an appreciation in the land rates, property rates, because people started working from home, etc. They wanted larger spaces. So based on that, I have taken. And other things, a simple increase of 15% is what I have taken.
It could be more, it could be less. Sometimes it would have fallen. I remember in Bangalore it fell a couple of times. So I mean that is not this is not the actual data. I have just taken an approximation. Whereas gold you can rely on this data, but this I have just taken an approximation of 15%. Now you can do whatever you want. You can take 10% appreciation, 15%, or a depreciation in the rates according. Depreciation is very rare scenario, but yeah, generally it's appreciation only. Now if you see that, if you have bought property 19, 20 and 21 and you are selling in 2024 for 5 crore. Well, let's say you bought a property for 2.5 crore in 2019 and today you are selling it for 5 crore. Very much possible. At least in Bangalore, these are the rates. In 2020, a property worth 2 crore is now has doubled already. Selling for 4 crore easily in good areas, not some random area. Good areas is what I'm saying. So as per my analysis, barring 2019, 20, 21, there would be definitely more money that you will have to shell out if you sell those properties in 2024 because of the skewed land rates. Barring that, all other years actually you will be saving money. For example, in 2001, if you have bought a property for 20 lakhs and today you are selling it for 5 CR, possible, 100% possible. That is in Bangalore, at least it is definitely possible, and Mumbai and all, don't even ask. A property which you bought 25 years ago for 20 lakhs and in Bangalore 5 crore is actually very less that I have taken. Assume you are selling today at 5 crore, very very less it is. By that logic, if you see, I will have to shell out now 47 lakh 50,000. Why? Because it's very simple, guys. 5 crore, 4 crore, or let's say let me make it 4 crore. Let me make it 5 crore now and see. Hold on. I had taken 4 crore, let me take it 5 crore. So if it's 5 crore minus 20 lakhs is 4.8 crore. On 4.8 crore, I have to pay 12.5%, which is 60 lakh. On the other hand, if I take indexation and this 100 rupees I bring up to speed to 363 rupees. So then indexation benefit, now I will have to shell out a capital gain of 85 lakhs, which means there is a 25 lakh saving. So contrary to those other assumptions where people thought in my a funny video also, I told that there are some benefits which I'll be releasing a video. That video is this. So definitely 2019, 20, 21, these three years is a problem. Apart from that, and gold, definitely these 4-5 years would be an issue, and 2020 is an issue generally. Apart from that, yeah, they have streamlined these things. Moving on, those are the things. Then the normal thing, guys, with is the new slab rates that they have brought in the 115 BAC. This is the default tax regime. In the default tax regime, we have these things up to 3 lakhs nil, 3 lakh to 6 lakh it used to be, now it's 3 lakh to 7 lakh. So 5%, 7 lakh to 10 lakh, 10%. These are the two changes. And this, I mean, used to be all 3 lakh differences. Now it is 2 lakh difference here. 10 to 12, 15%, 12 to 15. Realignment of the slab rates. That's all. So it used to be 3 to 6, 6 to 9, 9 to 12. So 3 to 6, 6 to 9, 9 to 12. That has become 3 to 7, 7 to 10, and 10 to 12 here. So 5%, 10%, 15%. So from 10 lakh to 12 lakh, it is 15%. From 12 lakh to 15 lakh, it is 20%. And above 15 lakh, it is 30%. Right, and standard deduction earlier it used to be 50,000, now it's increased to 75,000. Family pension, it is proposed to be increased from the existing limit of 15,000 to 25,000. And the employer's contribution to the NPS, that is the National Pension Scheme, has been proposed. So presently it's 10% is what it is. Now they are increasing it to 14% of salary to the concerned employees. For the private sector employees, that employer's contribution. This is a good change. So these are for, so all these amendments here will take effect from 1st day of April 2025 and will accordingly be applied to assessment year 25, 26 and subsequent years. Right? because whenever I say first day of April 25, it means assessment year. So assessment year 25-26, which means previous year 24-25, this year only. TDS also, there have been quite a few changes in TDS. 194D, payment of insurance commission. From 5% they have reduced to 2%. 194DA, life insurance policy, 5 to 2%. Lottery tickets, 5% to 2% reduction. Commission on brokerage, 5 to 2. Payment of rent by certain individuals, 5 to 2. Payment of rent by certain individuals or HUF, 5 to 2. This is, of rent, then commission of brokerage. Then certain sums by certain individuals or Hindu undivided family, 194M. This is an individual paying TDS, individual deducting TDS for employing professional services and contract services, etc. So this has been reduced from 5% to 2%. 194O, that is payment made to e-commerce operator. Certain sums made by e-commerce operator has been reduced from 1% existing to 0.1%. So hold on, I'll just show you that particular chart. So yes guys, so 194O, certain sums by e-commerce operator. So for example, this is how it looks. So let us say seller who's a payee, he is selling goods or services to e-commerce operator, let's say Amazon, and Amazon is then selling to the buyer. So if I go and buy on Amazon, obviously somebody would have listed all their products there, and the seller should be a resident in India and buyer can be anybody, no problem. So the payer and deductor here, the responsibility is thrust on the e-commerce operator, whether it is a resident or non-resident, and they should have paid 1% of the gross amount of sales. So if I actually make a sale, whatever the sale amount, 1% I have to deduct and then pay to the seller. Now this was similar to the equalization levy, which was also there by the Finance Act 2020, if I'm not wrong. So if you see, consequentially, even they have removed the equalization levy as well because of that. So if you see, equalization levy there of 2% shall not be applicable to consideration received for e-commerce supply of services on or after 1st August 2024. However, the corresponding exemption will be available. So they have just rationalized both the things. They have reduced this rate also from 1% to just 0.1% now. From 1st October it will take effect. So 194O, payment of certain sums by the e-commerce operator. Then of course, relating to the repurchase of mutual funds, etc., that will be proposed to be omitted because a lot of representations were received saying that again please do not do the TDS in that area. That was what it is there. So these are some of the amendments there. TDS, that was a thing. And of course, if you have, for ease of doing business and extension of the scope of lower deduction of tax. So if you want, they have amended 197(1) and 194Q within the ambit of this lower deduction of tax, and also they are amending 206C, that is all relating to TCS points. So in case you want lower deduction, you can apply under these sections as well, right? Apart from that, there was in the year 2012, right, there are a lot of angel investors pumping money into the company. The company's fair market value used to be just what, let's say the FMB used to the cost of shares used to be just 100 rupees. So that only will be my fair market value, right? So what used to happen was, I'm a company having shares of just 100 rupees each, whereas you come to me and say I'll pump in money worth 400 rupees per share. Now that extra 300 rupees that you are pumping in, that is the premium that you are giving. And mind you, this is not a listed company, this is a company which is a private company. So why would somebody invest in you so much money? Either it's conversion of black to white, or it would be an angel investor who has a lot of money, who wants to invest in you because he likes your idea. So your valuation is just, let's say, around 100 rupees per share, but he is pumping in 400 rupees per share, 300 rupees premium. Now that was taxed in the year 2012. Share premium in excess of the fair market value to be treated as income. So they did the valuation was just 100, but you're pumping in 400, 300 extra. That used to be called as angel tax. Angel tax. Now 2012 to 2024, lot of things have changed, and that is why, my dear friends, to rationalize again, they are deleting the concept of angel tax. The Finance Bill 2024 proposes to insert a sunset clause in share issue valuation norm in 5627B to provide that this provision will not apply from assessment year 25-26 onward. So the angel tax is abolished. Now, in the search based assessment cases, what used to happen was there used to be a block concept. Like for every 6 years, all the assessments that are happening during those 6 years when a search is initiated, the other assessments used to cease, or there used to be a pause mechanism on that, and this assessment used to happen. Now in the year 2021 and 22, the block mechanism, block assessment concept was abolished, and they came out with another assessment whereby you could go with in a different way. Now let me not go so much into depth into that, because that will take another session only altogether. There was an interesting judgment. Which came about, which kind of changed the entire mechanism, and that was the judgment in Abhisar Bildwell, Supreme Court judgment. The thing is, when I come and do a search, when the assessing officer comes and searches your premises, if he finds any incriminating evidence, means something which is directly which is income escaping assessment, incriminating material which would ensure that you have actually committed a fraud and embezzled cash, and or rather not shown the full picture to the department, then you can go ahead and do something. That's okay. But under the garb of that particular search, can I find out other material which was not on record before, but now suddenly it has come on record, add everything, open all the assessments up, was the question. So in that Supreme Court judgment, they very clearly said that you cannot make any additions in respect of those completed assessments. Right? All assessments are already completed. You cannot, reopen them under the garb of search and survey under the block assessment concept. However, they said you can still go under 147 and 148, that is income escaping assessment route. Separately you can go, but under search and seizure route you cannot go, is what they had told in that Abhisar Bildwell case. Keeping that in mind, and also seeing that there is lot of delay. See, theoretically the new amendments in 2021-22 was very good, but then practically speaking it was a Herculean task for the department to follow. So that is why, let us see that. I wanted to show you that as well. That part also has been removed. So if you see there, just a sec, yeah. As I said, the block assessments were initially abolished. If the AO has information which suggests that the income is escaping assessment, as I told you, notice under 148 can still be issued if 10 years have not yet elapsed. So searches conducted by this department means unearthing black money, but this used to have staggering search cases and used to take a lot of time. The entire procedure itself used to take a lot of time. So the thing is, that's the reason why the 132 came into force only was early finalization of the search assessment cases, etc. So that's the reason why, since it was not at all working out for them, they have brought in the search block mechanism again, block assessment. So on this I can take a separate class with lot of examples, but probably I'll do it some other time, because this was just a quick analysis of the provisions. This is a very interesting thing. Anyway, it will be covered in my class very much in depth. Minimum 3 to 4 hours we are going to spend on what was there before, what changed, again how this came. So in my classes we'll do it, and probably I'll release the same video. It's a very interesting concept, and we'll analyze this Abhisar Bildwell judgments also carefully. Right. So apart from that, the TCS provisions also there are changes, etc. Then coming to 50 AA, before we go on to the other things, 50 AA, one change has come. Right. So what was the definition of the market-linked debenture, market-linked instruments? It was not more than 35% investment in equity shares. But this also impacted your exchange traded funds, gold mutual funds and gold ETFs, because there also not more than 35% was there in these funds. So will these also come under 50 AA was the question. That's why they have changed the definition of specified mutual fund. Rather than telling not less than 35%, right? Not less than, they not more than 35%, sorry. Rather than telling not more than 35%, what have they told? So guys, in 50 AA, market linked debentures dialogue was what? Investment in equity must be less than or equal to 35%. But the problem was, as I told you, exchange traded funds also, gold ETFs also had the same norm where they were not investing more than 35%. Which means, do they also have to come under the 50 AA ambit was the question. So they decided to change the definition of what is specified mutual fund. And now what have they told? They are saying specified mutual fund means which invests more than 65% in debt and money market. Very simple. Rather than telling not more than 35, they are telling not more than 35 in equity. Now they are telling it should be more than 65% in debt. Good one. Right? TDS will see. And guys, income from house property, many people have multiple homes, 2-3 homes. I know a person in Chennai. When I go there, I stay in an Airbnb. He has around 10 to 15 extra homes. What he does, he runs it as a business Airbnb, where you can go pay there, sleep, and use the facilities. And generally it will be less than a hotel and more than rental. So if you are getting a rental of 25,000 through Airbnb, you can charge around 3,000 rupees per day for that room and you'll get 90,000. Technically it's a residential property, but people were claiming it as business, taking huge expenses, 60-70,000, and only offering 10 to 15,000 per month as income, or even less. Now this has been changed now. Some taxpayers are reporting the rental income generated by letting out house property under the head PGBP in place of income from house property. They are reducing their tax liability substantially. In view of the same, proposed to amend section 28 of the Act to clarify that any income from letting out of residential house will now be under profit and gains of business, PGBP. From PGBP, they have removed completely. It used to be PGBP, correct? So from PGBP, no claiming expenses, nothing. Whatever you had in PGBP is now unfortunately shifted to income from house property. And in income from house property, the only deduction you will get is 30% standard deduction. This is gone. Here, if I used to earn, let's say 10 lakh from that house, I would claim 8 lakh as expenses, offer 2 lakh income. Now I should show 10 lakh as income from house property, only 30% deduction you will get, and 7 lakh you will have to pay tax. Simple as that. On 7 lakh you have to pay tax. So that is also, though it may be a minor change and not many may have this, but yes, those who have, it will be impacted. So maybe they should float a company and transfer all the properties there. It's a difficult process, but yes, that is the thing that you have to do, no choice. As far as partners are concerned, partnership firm 40B disallowances or other limit of remuneration, etc., used to be earlier up to 3 lakh you had 1,50,000 or 90%, etc. Now to rationalize, it's been there since many years. Now they are told on the first 6 lakh of the book profit, you will get 3 lakh rupees or 90% of the book profit, whichever is more is allowed. And on the balance book profit, 60% would be allowed. So if my book profit, let's say after calculating the book profit, it is 9 lakh rupees. On the first 6 lakh, Either I'll get 3 lakh or 90%. So 90% is higher. 5 lakh 40,000 I can pay remuneration. On the balance 3 lakh I can pay 60%, 1 lakh 80,000. So 5.4 lakh plus 1.8 lakh is what I can pay to the working partners of the firm. Now, since you can claim that extra remuneration, what they have done is they have also brought about a new section 194T TDS. Any payment, that is salary, remuneration, commission, bonus, interest, anything that they are doing, TDS will be liable at 20,000 TDS. 10% TDS, my bad, 10% TDS. But my question is, if the aggregate amount that you are paying to that person is more than 20,000 in the financial year, guys, which firm will pay less than 20,000, that is salary, remuneration, commission, bonus put together? Right, not possible. So applicable TDS rate will always apply 10%. If you are getting less than or equal to 20,000 rupees in the financial year, no TDS. If you are, that is what, all put together, salary, remuneration, commission, bonus, interest, or whatever name called, the limit it is. If it is more than 20,000, then how much? 10% every time you are making the payout. This is what it is. So they have amended the Black Money Act also, that the provisions of this section, the penalty for non-disclosure, etc., will not apply if you have not disclosed asset worth 20 lakhs, because 20 lakhs now is very small amount. 30 lakh, 40 lakh, 1 crore, 2 crore, all these things you will, if you have that undisclosed income, on that you will pay a penalty. But that penalty for non-disclosure up to 20 lakh rupees I will remove, no problem. One deadly provision is buyback of shares. Buyback of shares now is treated as deemed dividend. Deadly point. So for example, Mr. A purchased 100 shares of XYZ Limited at a price of 50 per share. Overall 5,000 rupees it is in the assessment year 22-23. The company now issued a buyback of these 100 shares at a price of 70 rupees per share. So 7,000 rupees. So guys, 5,000 rupees has become 7,000 rupees. Technically speaking, the gain you should tax, 2,000 rupees is what you should tax, because that is what, 5,000 rupees I invested, 7,000 rupees I am getting it now as a buyback. 2,000 rupees I should tax, because it's a long-term capital gain. But very, very shockingly, now they are telling the entire 7,000 will be called as deemed dividend. Deadly. So that entire 7,000 I will tax. What about this 5,000 rupees which I have already invested in that company? So they say this will be taken as a capital loss, and this can be set off against any future gain, if at all it's there. Otherwise it will be carried forward. Very, very deadly. So any buyback now is kind of disadvantageous to the shareholder because of the tax impact. So this will have far-reaching consequences, and lot of analysis has to be made even by the companies when they are offering the buyback. So these are all the major changes, I would say, my dear friends, in the entire new budget, which had many, many changes, small changes, good changes, bad changes, whatever the case may be. This is what it is, and ultimately it is widening and deepening of the tax base is what the idea is all about. So that is what it is. So many multifarious changes, especially in the TDS sections, many things have come. So let me know your comments on the budget. Still further analysis has to be done. It just came yesterday. I haven't had the time to go through like completely in depth and analyze many things, but of course I am very keen on doing the video on the assessment procedure, because we can do what is the old one, new one, and the case law, everything. I'll be doing that. Anyway, in my class, I'll be doing that. This also will be done. Apart from that, guys, what are your thoughts on the budget? Let me know. Is it good for the country, bad for the country, what it is, and how do you feel for a middle class person, how it was? Did it impact in any way? Will it have an impact? Let me know, guys. Take care. Love you all. Please do comment. It will be nice. And like and subscribe, and do share this video if you like it. Take care. Love you all.